All right, everybody. Welcome to the Underwriting Fundamentals Workshop. It's always fun when we do underwriting. This is one of the most anticipated masterclasses that I've done over the last couple of years. I've done it a few times, and every time it's been very well received. I try to change it up every time I do it. And as usual, I've got quite a few things on this presentation that I haven't done before. If you were on the presentation 2 weeks ago, we talked about the 6 underwriting fundamentals or assumptions. We are going to go over those again, but the first 2 sections of this 3-part masterclass will involve other portions that I haven't taught at all. So you guys are going to be the first to see it, except for the definitions and acronyms in the APOD. When we get into that, strategic partnering members that have taken the strategic partnering workshop, they are familiar with that, but this is the first time I have taught it in a free setting. So you'll be the first to see it if you are not a strategic partnering member at this time. Okay, so I am going to get things rolling here. Let's move on. Let's get the technology working here. So quick disclaimer, I am not an attorney nor a CPA. I do not play one on TV or pretend to be one in real or imaginary life. This material is for educational purposes only and should not be considered advice. Consult your own attorney and or CPA for such advice. Okay, legal stuff out of the way. Let's move on. What are we going to talk about today? Well, what you've been taught, which I could guarantee is wrong unless you've been through CCIM education or through my strategic partnering workshop, versus the true underwriting fundamentals. So I'm going to go through and show you what you've been taught up to this point. And if you just got into this business in the last 5 or 6 years, or even sooner than that, I can guarantee you, if you have not been through CCIM or my course, you have been taught how to underwrite incorrectly. So we're going to go over the actual fundamentals of how to properly underwrite a deal. Then we're going to define the annual property operating data. Please mute if you are not asking a question at this time, if you don't mind. We're going to define the annual property operating data, or APOD. So I will actually go down the APOD. So when you look at a T12 or a profit and loss statement, each one of those lines represents the annual property operating data. So we're going to define what each of those are and what we're looking for in each one. And then we're going to define some of the key performance indicators like net present value, IRR, discount rate, break-even occupancy, things like that. We'll go over those definitions, those acronyms, so that you guys get a good understanding of how to fundamentally underwrite a deal. I'm sure some of you have never even heard of net present value or discount rate. We will educate you on that in this class. Then I'll define the 6 fundamental assumptions and their tests. Again, we looked at that in the class 2 weeks ago. We're going to go over it again because it is part of the fundamental underwriting, and then talk about what's next. So for those that don't know me, my name is David Monroe. I am a CCIM, which is a certified commercial investment member. We are considered to be the MBA of commercial real estate. As a matter of fact, 135 universities across this country utilize the CCIM curriculum as the curriculum for their MBA programs for their real estate stuff. I happen to be one of only 60 instructors for the CCIM Institute, and I teach market analysis. So I am a multifamily investor and strategic consultant. I am the CCIM market analysis instructor, which is CI 102. I am on the CCIM tech board, VP this year. I'm going to be the marketing executive for the tech board next year. I am a foundations board member, which is the capital raising arm of the Institute. I will be the Ward Center Committee Chair next year, which just means I have a whole lot of responsibilities, and the Ward Center is another education arm of the CCIM Institute. I am founder of the Strategic Partnering Community, a former syndicator, now passive investor, and I have owned a property management company in the past. Now, let me caveat this. This is not a CCIM sanctioned course, but the underwriting fundamentals that are in this course, do come from the CCIM curriculum and most financial analysis curriculum in most of the universities across this country. So these are fundamental principles, but this is not a CCIM sanctioned course. I just happen to love CCIM, and that is part of my background. And so that's why it's all here. Just want to make sure that you understand that. All right. What you've been taught versus the underwriting fundamentals. So what have you been taught? Well, it hasn't been good, I can tell you that. So that it's okay to overpay. The market will come to you. Yes, I heard a guru in, I think it was April of last year. I went to one of his virtual conferences, and he actually said that on stage. It is okay. As a matter of fact, you need to put your offer in 10% above asking price so that you can be competitive. Don't worry about it. The market will come to you. That's disgusting. Okay. So do not do that. Please do not ever do that. There are some principles that you can use that will allow you to do something like that, but that blanket statement does not make sense. And it must be in a market that will accept it. We are outside of that market now. For the last 3 or 4 years, you could do that. Now you can't. All right. So, but the blanket statement of it's okay to overpay, the market will come to you, is just flat wrong. So take the OM, the rent roll, and the T12 and put the information in your underwriting model. That's what you've been taught. Don't go into the marketplace and prove your market rents or anything else. The OM and the broker, they know what they're doing. Take all that information, throw it in your underwriting model, hit go, and then use the colors to determine if it's a go, no-go decision. Yeah, okay. So when we get into the definitions and acronyms, you're going to realize that discount rate and net present value and internal rate of return are all intertwined together. Now, you're probably familiar with IRR, internal rate of return. That's the return you get for the entire holding period. It's really deeper than that, and we'll go into that when we get to it. But what you're basically saying, and I'm going to go ahead and poke fun at what I'm talking about here, because most people utilize Michael Blanc's syndicated deal analyzer. You get colors that tell you green for go, yellow for caution, red for bad, but it's based on a 14% internal rate of return. Well, that means that Michael Blanc's discount rate is 14%, and discount rate's directly correlated to risk. So you are utilizing Michael Blanc's risk in order to determine whether this is a good deal or not. And a lot of the tools are that way. I know there's different tools from different people, but if it has these, what's the word I'm looking for here? Rules of thumb that you put in for expenses and income and all this other stuff, all this craziness inside of them, none of that are fundamental principles. And if you follow these, you will get in trouble. Now, because of the appreciation that we've had in the last few years, people have gotten away with it. I commend them for it. I'm not knocking them at all, but that time is over. The market has changed. So we need to pay attention. So do not utilize the red, yellow, green of the syndicated deal analyzer or any other analyzer out there to determine your own risk. And we'll get to that when I get to discount rate. They tell you to underwrite to the business plan. What does that mean? That means pro forma. Go ahead and do your 5-year cash flows, even if you're going to sell it in 2 years. Determine what you can raise your rents to, lower your expenses, take that NOI, divide it by the cap rate, and get your value. And you're underwriting to that value, not the value you're buying it today, the value you get after you have done your business plan. So you're determining the value from the completion of that business plan. That's insane. But that's what people have been doing. Now, I'm going to explain to you here in a couple of minutes why that's so bad. And I've said this in some other videos. I did it in a Facebook Live. I don't think I've done it on YouTube yet, which is coming soon to a theater near you. But I will explain here in a minute in the next section why that's so bad and who is actually benefiting from you underwriting this way. But this is what you've been taught. You have been taught to underwrite to the business plan. not underwrite to existing financials, which, by the way, is the fundamental principle of underwriting today's financials. Use bridge debt to get an interest-only period. That's what you're being told today. So you're being taught today, use bridge debt. 3 years ago, before bridge debt lowered their interest rates low enough where it made sense to be able to utilize bridge debt for acquisitions, which is not what bridge debt is for, by the way, it was the strategy you were taught was find a Fannie Freddie loan that has an assumable loan on it and purchase that. If you can get it before it's got that Fannie Freddie, put a Fannie Freddie on it and then sell it in 3 to 5 years with that assumable debt to the next person in line so that they can benefit from it. Again, these are strategies. These are tactics. These aren't fundamental principles. And that's fine in a hot market. The hot market's over. All right. So you need to stop doing this. I know this is what you were taught. I'm not saying it was wrong to do it this way. Could have been taught a little better to where you understood what you were actually doing, but it has worked over the last 3 to 4 years, but that time has ended. So let's look at what this will do. Okay. So of course you sell when the loan is due or refi, which right now, if you get bridge debt today, you are not going to be able to sell or refi it out because of the interest rates climbing as much as they are. Those that bought 2 years ago that haven't sold their bridge out yet, they're going to be in a little bit of trouble. All right, so here's the truth. So that's what you're taught. Now, what does all that mean? What's the truth of everything we just talked about? Well, the seller gets the benefit of the value add. Think about this, all right? You're buying a property on pro forma. You determine that in year 2 or 3, the NOI is this. You take that NOI and you divide it by the market cap rate and you get X. You're buying that property on X based off of that year 2 or year 3 NOI. That's called buying on pro forma. The seller, who's laughing his butt off, by the way, is able to do maybe 20% of the units, maybe did some of the exterior, maybe not, prove the rent bumps, and then sell it to you at a future price, not today's price, which means you're paying the seller for you to have the right to do the rest of the improvements, take all the risk of the improvements, take all the risk of leasing up to the market rents. You're going to give the seller that money on day one so that you've got the right to do that with the hopes that you perfect your business plan and that you can appreciate the property and be able to sell it for a 2 or 3x multiple in 3 to 5 years. That's the way people have been buying for the last 4 years, actually the last 6 or 7 years. Institutions started this because they identified, in order to be competitive, that if they took their business plan and determined what the NOI could be in year 2, 3, whenever that was going to be, what that stabilized number was, if they could get a 2% spread from the cost of what it costs them to buy the property to today's value, then they would purchase it on pro forma. That's what developers do. They purchase vacant land, they do a feasibility analysis, and they determine what's called a market cap spread. It's going to cost me this much to buy the property and build it. In 2 years or 3 years, when that is completed and leased up, value is going to be this. Is the cap rate from what it cost me versus what the market cap was to today's value. So if I bought it at a 7% and the value today is 5% or 2 or 3 years from now, that is a 2% cost markup spread. That's what developers are doing. Institutions realize they can do that on value add. Well, some of the syndication gurus caught that and said, oh, well, we can teach our students to do that, but we're not actually going to explain to them what they're really doing. We're just going to tell them it's okay to buy it on pro forma. And in actuality, that's really what they're doing, but it's not. You still have to use those fundamental principles and look at that market cap spread and make sure you get that cap spread, which is all built on your risk, that discount rate. There's that word again, discount rate. So we're going to come back to that. All right. So the seller is getting the benefit of the value add, and they don't have to do any of the work. None of it. You're buying it. They get to go to the bank with it. Thank you, Mr. Buyer, all the way to the bank. And then the buyer has to risk doing all that work and then selling it and then rinse and repeat. Now the one who bought the property is now selling the property, and now they're the one laughing all the way to the bank. That's what's been going on for about the last 6 years. Okay. Those days are over. So you're paying the seller for the right to make the improvements and take all that risk. All right. You are hoping for appreciation. Now, this has worked for about 3 to 6 years, but the market's changed, and this strategy will not continue to be profitable. Let me see if this is a question here. Okay, that's Diane talking about a deal that she's involved in Arizona. So urge you guys to take a look at that. Fundamentals. All right, so we know what you've been taught, and we know what that truly means. Now let's look at what are the fundamentals. So what you've been taught versus the fundamentals. Well, first, ignore the OM. Now, there are pieces of the OM that you're going to need to know. There's some good market information that you can gather that can be a starting point. You're still going to do a market analysis, but you can get some decent market information from the OM. Do not, under any circumstance, rely on any of the financials except the rent roll and the T12. Okay, those are the two documents that you are going to need in order to underwrite this deal. Use a data-driven approach from a current supply-side data source. I personally use CoStar. I also use Site to Do Business for my demand side, which is a CCIM product. So you're going to need to go in and verify your assumptions. We'll go over these assumptions in the last section. These assumptions we can find inside our supply and demand data set tools like CoStar, like Reese, Axiometrics, Yardi Matrix, whatever it is that you use for your supply side data, not Rent-A-Meter, not apartments.com. Do I need to say that again? Not Rent-A-Meter, not apartments.com. You need a supply side data source that's going to give you vacancy. It's going to give you total of units in the market. It's going to give you absorption. It's going to give you a historical look at the rents so that you can determine rent growth or rent decline over a given period. And it's going to give you under construction, proposed, and all this other information. You're not going to get that from apartments.com or from Rent-A-Meter. They're only going to give you asking rents today. That's it. That's not enough information. Okay. If you don't have CoStar, it's okay. There are plenty of brokers and plenty of other syndicators in the marketplace that have it. Ask for the data. Okay. Just make sure you have some value in return that you can reciprocate with. So you're going to underwrite to the year one cash flow before tax, not to the end of your business plan, because the lender is underwriting to year one cash flow before tax so that they can determine the debt service coverage ratio. So if we're going to use long-term debt today, okay, no more bridge, no more short-term, long-term debt, and you want to be able to get 75% LTV. If you cannot get 75% LTV, it's because your debt service coverage ratio in year one did not make it according to the lender's underwriting. I hear all the time people say, I can't get Fannie Freddie to get anything greater than 55% LTV. It's because your DSCR in year one doesn't work. You got to hit that minimum DSCR, and not on pro forma, not on projected rents, on actual financials. Okay, that's right, Morgan, the financials of the property. So T12, sorry, thank you, Brad. T12 is trailing 12-month profit and loss. So it's on a monthly basis. I don't have an example of it here. Of course, I do it in the workshop and in my my big course and other training that I do. But the trailing 12-month is basically a P&L that has been broke down by the last 12 months. So we're in November. So the trailing 12 would be from November 2021 to October 2022. That would be the trailing 12 month. And it would have everything in the APOD that we're getting ready to go over in a minute. Hope that answers your question, V. May. I don't know how to pronounce that, but thank you, Brad, for answering that. All right, so long-term debt, 75% LTV. You're going to find out that when we get to the test for our loan assumptions, that getting a loan with 75% LTV is one of the ways to make sure you've properly underwritten this deal. Because if you can't get it for 75% LTV, there's a good chance that you have overvalued this asset and you're going to overpay. So then when the business plan is complete, typically 5+ years, I never recommend less than 5 years. There are tax implications when you sell it in less than 5 years. I don't care about bonus depreciation. Bonus depreciation is actually hurting investors right now because your capital gain is at most 20%. But when you get bonus depreciation, you got to recapture that depreciation. And guess what you recapture it at? Who could put in the chat what we recapture? What's the tax on recapture for depreciation? Does anybody know? Where are my CCIMs in here? 25%. You guys got it. So you can get capital gain at 20%, or you can recapture at 25%. In what world does that make sense? That you would try to get all that depreciation at once so that you could pay tax on it. Now, if you were holding the property for 7+ years, it'd be okay, because then you will have paid for that depreciation. But when you sell it in 2 or 3 years, like what's been going on, you're hurting the people that are actually investing in this deal that are expecting to get a tax break, because they're actually going to pay more in tax than they would have if you wouldn't have got the bonus depreciation. I'm going to leave that at that. Okay. Something else you're being lied about. All right. So that is what you've been taught versus the fundamentals. Okay. So now let's define the annual property operating data. So here is a infographic, if you will, of what the APOD looks like. Very kind of generic looking. So we start with, let me get my little handy dandy laser pointer here. So we start here with potential rental income. So potential rental income can be two things. It can either be the highest rent you've been able to achieve for that unit type on the property. And there's a lot of investors that or operators that will use that metric for their potential rental income. There are other people that will use the market rent in the area, which has to be determined by a market analysis, and they'll use that for potential rental income. Either one is okay. If you are utilizing either of them, when you do vacancy and credit loss, and potential rental income's acronym is PRI. So if you see PRI, that's potential rental income. If you're using potential rental income and just not cash collected, that means when you do vacancy and credit loss, you're also doing loss to lease. So above vacancy and credit loss would be loss to lease, because you're pro forma-ing, if you will, your rents. So if your lease amounts do not equal your potential rental income, then that difference is that loss to lease. From loss to lease, we then subtract out our vacancy and our credit losses. That gets us to our economic occupancy. So when you take potential rental income minus vacancy and credit loss, you get really, it could either be gross rental income or effective rental income. Either one works, ERI or GRI. You'll see it both ways. We then include in other income. So if you're doing a RUBS or getting utilities back, then you can include that. If you've got laundry income, parking income, storage income, trash concierge, there's all kinds of other income that you can collect, plus other income from our gross or effective rental income gets us to our gross operating income, or GOI. We then take out our operating expenses. Now, what's the difference between an operating expense and a capital expense? An operating expense is anything that's required to operate the property. A property does not need a mortgage to operate. So the mortgage interest and the mortgage principal is not included in the operating expenses. But the property does have to pay property tax, and it does need insurance. So insurance and property taxes are included in operating expenses. The property does not need an asset manager to operate. So asset management fees are not considered an operating expense. They are what we call below the line expenses. They belong down with annual debt service in there. Your capital expenses, which you can depreciate. And because depreciation does not go in operating expenses, because a property does not need to depreciate to operate, capital expenses also go below the net operating income and belong with annual debt service. So what's the difference between an operating expense and a capital expense? Best way defined by the IRS is if it's a replaceable item, like a hot water heater. If you replace a hot water heater, instead of repairing it, it is a capital expense because now you can depreciate that hot water heater. If you repair the hot water heater, that is an operating expense. They do allow you to replace carpet because of the wear and tear as an operating expense. Painting walls, operating expense. If you replace a few sets of shingles on a roof, that's considered a repair. That's an operating expense. If you replace the whole roof, that is a capital expense and goes below the line. Why does all this matter? Because getting to cash flow before tax, you're getting a dollar for dollar reduction in your operating expenses once we get after cash flow before tax and we start talking about our taxable income. So the more we can do in operating expenses during operations, the lower our tax is. Now, when you go to sell the property, the least amount of operating expenses is better because now we can increase the NOI from that to drive the value of the property up. Don't use that strategy. That's a tactic, not a fundamental principle, and it can get you in trouble. So once we subtract our operating expenses from the gross operating income, that gets us to net operating income. That's our NOI. NOI divided by the purchase price gives us our cap rate. The NOI, did I say that right? No. Yes. NOI divided by purchase price gets us our cap rate. NOI divided by cap rate gets us our purchase price. Purchase price times our cap rate should tell us what our NOI should be. All right. So in year one, we are working towards that cash flow before tax using this APOD. The last thing is below the line expenses. Below the line meaning below net operating income is annual debt service, your asset management fee, capital expenses, things like that. Let me look at some questions here. What about deposit to replacement reserve? Okay. If you are purchasing the property, now I have this argument that a reserve means the money has not been spent. So how can it be an expense? But lenders are requiring you to put that in your operating expenses. I can't control that. So it does have to go in there when you're purchasing the property. And then you have to keep it up based on whatever that number is. So if they want $200 a unit on an annualized basis and you spend some of that money, it does have to be replenished each year. So you keep that $200 a unit in there, and they want it in the operating expenses. So that's a good question, but it's lender driven, but it makes zero sense because the money hasn't been spent. It's just in an escrow account. Yes, Todd, we will be sending out the recording. All right. So that gets us to cash flow before tax. We're not going to go into after tax at this point. Nobody teaches after tax. I don't know why. We will be teaching after tax in the workshop because it is very, very important. It is specific to every single investor, much like your risk is, much like your discount rate is, but it still needs to be known so that you stop making the mistake of thinking bonus depreciation is going to help you. Okay. So let's move on. So let's talk about definitions and acronyms for some of the KPIs we need to know. The first is the discount rate. The discount rate is the interest rate used to discount a stream of cash flows to their present value. When the discount rate and the internal rate of return are equal, then net present value is zero. We're going to talk about internal rate of return, net present value in a minute. This is where I told you I'm going to start going over some people's heads. Okay. You've probably got quite a few pieces of information here you've never heard before. Oh, cool. Thanks, Roger. Appreciate that, bud. So an easier way to say this, that's the book definition. An easier way to say this is your discount rate is your risk. So if I want a 14%, let's go back to the Michael Blanc model. If I want a 14% internal rate of return, then my discount rate is 14%. Because when I do my discounted cash flow model, which you still have to do, we're underwriting to year one, but we still need the whole discounted cash flow model over our business plan period, so that we can determine what the value of the asset is based on our discount rate and the internal rate of return. So as we work through that, and we're going to use some good fundamental principles to get us there, good conservative fundamental principles and not aggressive stuff people have been using. We'll talk about it when we get there. When that internal rate of return is 14% and your discount rate is 14%, that means we met our risk minimum. And that means that the net present value is zero. Net present value is useful, and you'll find this out in a second. It is just simply the difference between value and cost. So if my net present value was negative, that means I have to subtract that number from the purchase price in order to get that discount rate, that internal rate of return I'm looking for. If net present value is positive, that means that I can overpay for the asset, be competitive if I want to be, but based on fundamental data, now I can overpay and still get my target return, that 14% internal rate of return. So I just add that positive MPV to the purchase price. That then becomes my strike price, or my pay no more than price. Okay. We always start lower as a buyer. We always start higher as a seller. That's just good negotiation. Right. So that's how discount rate works. It's your risk. So institutions call this their weighted average cost of capital, or their WACC. No, we are not going into that. You do not need to know that. But if you start investing or brokering with institutions, talk to me, because then you will need to know it. Internal rate of return. This is the rate of return each dollar in an investment, not when it comes out, when it stays in. So the rate of return for each dollar in an investment earns while it's in the investment, and gives investors the means to compare alternative investments based on their yield. This is the book definition, which probably just went over everybody's head. The internal rate of return is the money that remains in the investment. We have a cash on cash return each year. That cash on cash return is irrelevant to the internal rate of return. The internal rate of return, so if I invested $50,000 and I get $6,000 at the end of year one, that means I still have $50,000 in the investment. The internal rate of return is based on that $50,000, not that $6,000 that comes out. All right. So as that grows over time, that is where the internal rate of return comes in, and it really gets calculated. It needs to have a time period zero, which is an investment in the deal, a negative number. That's our whoop out money. We're going to pull money out of our pocket. We're going to invest it in the deal. In order to calculate internal rate of return, you have to have that initial investment. We call that time period zero. Then when you sell the investment, okay, that is your reversion, the sale of the property. We need that sale in order to determine what the final return was on the asset, that last cash on cash, what that reversion rate was. All that combined gets us to our internal rate of return. Okay. And then of course, our internal rate of return, utilizing the discount rate. If the discount rate is higher than the internal rate of return, our net present value is going to be negative, means we are overpaying for the asset. If our internal rate of return is higher than our discount rate, then it's positive and we can overpay and still get the same return that we want. All right, that's how we calculate that. And then net present value is simply the difference between value and cost. Now you've got to get investment value and you discount the cash flows using your discount rate. And there's a way to do it. I'm not going to go into the math. I do go into the math in the workshop. The math will just confuse you right now. Just know that net present value is nothing more than the difference between value and cost. That is the easiest definition for this. Let's see. We got talk here up. Let me get rid of my little pointer here so I can come on now. There we go. All right, there we go. Now I can see these. Let's see. Tom says, maybe depends on your situation. I'll take bonus depreciation. I can get time value of money. Well, what you got to be careful of, Tom, that's all fine and dandy if you're going to hold it long term. But if you're going to hold it short term, then your taxes are going to be greater than if you did not take the bonus depreciation. And if you want to reach me offline, I'll show you how that math works. But we're not going to go into it here. We are going to go into it in the workshop, though. All right, let's keep moving. Cash on cash return is next. This one's pretty simple. This is just the result of dividing the cash flow before tax, or CFBT, and the total amount of equity invested in the property. So if we got a 75% loan to value, and we have closing costs, and maybe we have some interest reserves, maybe we got some capital reserves, all the money that comes out of our and our investors' pocket and goes into the deal, that is the total amount of equity invested. That is what gets divided by the cash flows each year to determine what that cash on cash return is. What makes this important is syndicators will give a preferred return, and that means typically it's around 8%. So if you're offering an 8% preferred return, that means if let's say you invested $100,000 and the deal only produced $7,000 at the end of the year, that is a 7% cash on cash return. That means the investors didn't get all of their return, so the sponsor doesn't get paid anything. And that $1,000 is still owed them, so now it gets tacked on to their capital account as long as they're on an accumulated basis. Most syndicators use an accumulated cash on cash return and not a straight line. If you are using straight line, you better make sure it's clear in the PPM. Be careful of that one. We're not going to go into that. All right. So it's simply the amount that you get at the end of the year divided by the amount invested gives you your cash on cash return. Your equity multiple is a metric that calculates the expected or achieved return, total return on an initial investment. It's calculated through an equity multiple formula that divides the total dollars received by the total dollars invested. So that's all the cash on cash returns and the return on the sale of the property. Because after everybody's caught up, then all the money's returned. Now you have that money remaining. That's part of the return. You add all those together, divide the total invested by the total distributions, and that will give you your equity multiple. Okay, really it's total distributions divided by total invested. Should be a larger number. Hopefully it's a larger number. Lately, it's been anywhere from 1.8 to 3, depending on how well the investors bought the property. This is what they've been relying on, the equity multiple. Okay, they've been buying on pro forma. This is why they bought on pro forma, was because of the equity multiple. All right, next is average annual return. So that is all the cash flows, years 1 through 5, if it's a 5-year hold, and the reversion, meaning the sale of the property. This, I don't like this metric. This metric is not taught at the financial institutions. It's not taught by CCIM, but it is used by syndicators to make the cash on cash look higher than it actually is, because you take into consideration the return you get from the sale of the property. So you take all the cash flows from year 1 through however long you have it, let's say 5 years, and the return from the sale of the property, and you divide it by 5 because it's a 5-year hold. So when you really only got a 3 or 4% cash on cash return, it makes you look like you got a 15 or 16% cash on cash return. So I don't like this metric, but it is there and it is being used, and you do need to know about it. Let's see. Is NPV getting my investment or seed money back? No, NPV has nothing to do with that. That's that. Can you speak to accrual versus cash? Not Mario, not today. No, we can talk about that in the workshop, but that goes beyond the scope of today's lesson. Which really, so I guess I can, and I did mention it. If you're using potential rental income, it's accrual. If you're not using potential rental income, it's cash. That's the best way to put it on a very, very general, basic term. Obviously, there's more involved. All right. Break even occupancy. So this is the sum of all the operating expenses and debt service. So you take all your operating expenses plus your debt service and you divide that by your potential rental income. If you don't have potential rental income and you just have your leased income, then you're going to divide it by your leased income. So total operating expenses plus total debt service divided by potential rental income. That is your break-even occupancy ratio. So when you guys are doing your tests to see your stress tests for vacancy and for reductions in rents, which are already occurring, you're going to utilize this formula to make sure that you don't go below your break-even occupancy. Now, your break-even occupancy will take you to a 0 or a 1.0 debt service coverage ratio. Be careful of that because there's a clause in your loan that says if you drop below the debt service coverage ratio minimum, the lender can call the loan due. So just be careful of that. All right. That's the APOD acronyms and definitions, as well as some of our KPIs that are most important to us. So let's look at the 6 assumptions and their tests. So first, the outputs of the market analysis become the inputs for your financial analysis. If you are not doing a market analysis, when you are doing your financial analysis, you have failed. Your outputs of that market analysis are your inputs for the financial analysis. You cannot get these assumptions without doing a market analysis. Do not cheat this part. If you don't know how to do it, find a course that will teach it. Obviously, I teach it. Email me. It's also in my Big Dog course, the Strategic Partnering Workshop. Or get with a broker that knows how to do it or somebody else that knows how to do it. But you need the outputs from your market analysis to get these assumptions for your financial analysis. You don't need them right away. You can do a 10-minute back of the napkin. You don't need a market analysis for that. But if your back of the napkin says this deserves a second look, now you got to start looking at the market. So now we're going back to some basics. So first, our properties must be cash flowing. We're not buying for appreciation today. We're buying for cash flow. Appreciation will kill you. Okay. That's what they've been doing, buying on pro forma. All right. We want to buy on cash flow. So it must be cash flowing. The debt must be permanent. All right. That again, if you're buying short-term debt right now, you're probably not going to survive the recession. Your going in cap rate must be above your interest rate. If your interest rate is higher on your loan than your cap rate, you have what's called negative leverage. That means if you would have paid cash for the property, you would get a higher rate of return than getting debt. That is the total backwards thinking. Normally we get debt so we can get a higher rate of return for our investment, right? So if you don't mind going negative leverage, it's not bad as long as you explain to your investors, if you have investors what you're doing, that your rate of return is going to be lower because you're buying at an interest rate higher than your cap rate. That's why when you hear as interest rates go up, cap rates go up, because we want to keep that leverage. If we don't, and we go the opposite direction, if we revert that, then we have negative leverage. And again, as we go negative leverage, you're getting a less and less and less return based on the amount you get from that loan for that property. Again, can't be an appreciation play, must be cash flowing. So what are our 6 assumptions? First is projected rents. Thanks, Diane. projected rents. These are the rents that the broker tells you that you can get by purchasing this asset. So we've been getting $1,300 a month, but the market says you can get $1,800 a month. So there's a $500 rent bump you can get for this asset, 3% cap rate. Okay, I'm being flippant there, but you know what I mean. Don't believe what that broker said. Go do your market analysis. Go get a CoStar report, a Reese report, a Axiometrics report, Yardi Matrix report. Get some supply side data tool that is going to show you what the projected rents are for that neighborhood or trade area or whatever you want to call it. It's defined a trade area. Normally between major roads, interstates, rail, hills, rivers, lakes, parks, all of these boundaries confine where your direct competition is located. If you do a 1 mile, a 3 mile, a 5 mile ring, you've already failed. You can't do that. You've got to identify that neighborhood. All right. That's what market analysis does for you. We get that neighborhood that this is in. It may not actually be a defined neighborhood by the municipality, but from our polygon we draw, because of these boundaries, we create that neighborhood, which becomes our direct competition. Those are the rents we're looking for. If you are looking at a property in Waxahachie, Texas, and you're getting rent comps from Addison, Texas, which are in complete different sides of Dallas, you've already failed. You can't do that. It has got to be in direct competition. All right. So projected rents, that's the number one misused. Well, they're all misused. This is one of the number one misused items. Now, here's the deal. We are still seeing year over year, although much, much smaller than 2021, we're still seeing year over year growth in rents. But for the first time since March of 2020 or second quarter of 2020, we are seeing reductions in rents quarter over quarter. From Q2 to Q3 2022, in most markets in the Sun Belt, there was a reduction in rents. Not a slowing down, a reduction. So pay attention to the data. Do not rely on what the broker tells you. Next is vacancy. Now we were looking for our total economic here. You may have a property that's 100% occupied. And right now that market may be at 97%. But if you look at the long-term occupancy average of that market, it may only have 93% long-term occupancy average. Here's what the lender is going to do. I always underwrite to the lender. The lender may give you 5%. That's a bare minimum, is 5% for a lender. They may give you 5%. And 6 months ago, I'd say they would give you 5% in those conditions. Today, I think you're going to see the lender's going to say, I'm going to look at that long-term occupancy average and I'm going to underwrite you at 7%. And then they're going to tack on vacancy and credit loss, or credit loss to that vacancy. So that's physical vacancy. Now we tack on credit loss. They're looking for about 2 to 3%. So you're going to end up somewhere around 9 to 10% total vacancy. Okay. So these vacancy projections have got to be data driven. Not some guess, not because of what it is today. What it is today is irrelevant to most people that are making decisions on this. It has got to be data driven over a period of time, looking at the averages. All right. Next is our income growth. Oh, this one's crazy. Now, honestly, between income and expense growth, I don't care what you put as long as they're equal. This is good conservative underwriting. Okay, let me tell you what I mean. I've seen as recently as 2 months ago, somebody had income growth at, I think it was like 12%. Oh, but 2021 was at 20%. We're being conservative. It was 12% year one, 9% year two, and then 6% year 3 through 5. Expense growth, 2% all 5 years. Last I checked, we're in an 8% plus inflationary environment, and we have been for quite some time. Doesn't look like it's slowing down anytime soon. Yes, there's been a flattening. We'll see how that continues. That's not what this is about. But how in the world could you say that income growth and your expense growth only be 2%? Here's what I'm telling you to do. Doesn't matter, right? It's irrelevant. If you want to put 8% for income growth, great. Use 8% for expense growth. If you want to use 2% for income growth, great. Use 2% for expense growth. Now you're not manipulating the model. Fact is, you don't know anyway. You have no idea what rent's going to be in 3 years. You have no idea what expenses are going to be next year, let alone 3 years, 4 years, 5 years from now. Just make them equal. Don't manipulate the model. That's good, fundamental, conservative underwriting. Then it doesn't matter. Next, we got our loan assumptions. This could be refi, the interest rate at refi, or it could be so it's your loan today as well as your refi, and we're going to test it with loan to value. So if, again, the lender will only give you 55% LTV, we probably have a problem with our debt service coverage ratio. So what's our interest rate going in today, and what's our interest rate at refi? If our going in interest rate is 7%, which is probably close to what it's going to be today, if you've got good credit and the lender likes you, even if it's non-recourse, don't think you're not getting some kind of recourse action here. There is the bad boy clause. That's why we have people on the loan that still have to guarantee on a personal level if the syndicator or the sponsor has fraud. That's what it's there for. So there's always some kind of personal guarantee on this. But my point is, we're looking at that interest rate because if our cap rate's 5% going in cap rate and our loan 7%, now we're negative leverage. So we need to pay attention to what our term sheet shows. If you're buying on an adjustable rate mortgage right now, go ahead and shoot yourself in the forehead now and get it over with. Get fixed debt. The lender is, especially buying these rate caps, the lenders aren't stupid. They're going to get their yield no matter what. Okay. They're going to get it from your upfront expenses, your upfront loan fee, your interest rate cap if you're getting a adjustable rate mortgage, all these things. They're going to get their yield. They know based on the market, based on the location, and based on you or everybody involved, they have a number in mind. That's their discount rate. They're going to get their discount rate, and they're going to get there by handing you a term sheet and start negotiating with you. All right. So they're not stupid. So don't play into their hand. Try to get a long-term fixed mortgage. It's going to have a little bit more interest involved in it, but so what? You're going to be safer. And as long as your debt service coverage ratio makes it and you can get 75% LTV, you'll survive the recession. Next is the exit cap rate. This is the most abused piece of information of the entire financial model. It is also the one that will change the model the greatest. So if, let's say I'm using the SDA and I need a 14% internal rate of return, and at the end, I only get a 13.6%, but I promise my investors 14. All I have to do is change the exit cap rate by 2 basis points. 50 basis points, 20 basis points, and it will make a huge difference in the internal rate of return. Do not manipulate the exit cap rate. And that's what that is. That is exit cap rate manipulation in your model. Use fundamental principles. Understand where we're going with loan interest rates right now. Interest rates are going up. I believe they're going to hit double digits before they come back down. They won't stay there long. They will come back down afterwards, but they're going to stabilize at long-term rates. If we look back at the last 30 to 50 years, we average about 6 to 8%. Really, it's about 6.5 to 7.5%. I mean, when's the last time you saw a 2% interest or a 3% interest? What, the 70s? It's rare, very rare. We're not going back there. Okay. We're going back to our long term. And I think we're going to stay there for 5+ years. So you need to utilize this data, this thinking, look at it economically and say, be a little conservative. What is it going to be 5 years from now? It's a guess any way you look at it, but at least you're using data to get there. Let's see. What we got going here? What's Leon say? Nothing like thinking you had a good deal until you remember to update. Yeah, roger that. All right, so what's the difference between exit cap and entry cap? Entry cap is the cap rate based on today's financials and the purchase price. That's entry cap. So NOI divided by purchase price is today's cap rate. Your exit cap rate is the cap rate you're going to use based on the NOI at the end of your business plan. So if you have a 5-year model, at the end of 5 years, if your NOI is X, then that reversion cap rate is what you're going to use, or that exit cap rate is what you're going to use to determine value. This is what drives the internal rate of return. That's why it's so important to use a data-driven approach on this. And if you don't get it right the first time, do not manipulate it to get it right, because you think you need a deal before the end of the year so you can get bonus depreciation. Don't get me started on that one again. All right, those are the 6 assumptions. So now let's test them. Checks and balances. How many people have been looking at median household income for their underwriting? Put in the chat. Matter of fact, put a yes in the chat if you are looking at median household income when determining your projected rents. I want to know. Yeah, we got a few. Good. Out of how many people are on here? 100? Yeah. Good. Awesome. Love it. Here's how we utilize median household income. Remember median. What does median mean? Median means middle. So that means that half the data is above the median household income and half the data is below the median household income. This is just the median. Here's how to utilize it. The apartment managers that know what they're doing. Now the owner has final decision, but the managers are pretty persuasive. They are going to talk the owners into income qualifications to afford the unit. What they are going to say is, we want to see 3 times the rent is their gross income for the month. So how do we determine that? Well, median household income is median household income divided by 12 to get to monthly. Divide that by 3, and there is the rent that should be your market rent for median household income. That should be the median rent. Okay. Again, half the market is above, half the market is below. Take that into consideration. So if you have a 300 unit property and there's, say, 10,000 units in the market, not 10,000 properties, 10,000 units, and 20% of your units have a $400 rent bump increase, but the remaining units are yet to be done, you better think about this median household income. Now, here's why rents are decreasing right now. Developers are still building. They are still delivering to the marketplace. Well, investors have completely ignored median household income. So what has happened is the affordability, which I've been talking about for 9 months. We have hit the affordability index, which means that the borrowers, or not the borrowers, the occupants, the renters, the residents, they can no longer afford those Class A rents. So there was a 40% reduction quarter over quarter from Q2 to Q3 in absorption. Absorption means all those units that were put on the market by the developers, there were 40% less renters renting those units than there were the prior quarter, which means prices are now dropping because developers cannot keep those units vacant. They must drop their prices. When the A's drop theirs, the B's drop theirs, the C's drop theirs. That's how we start to get rental reductions in markets. Okay. The reason? Affordability. My argument I get all the time, yeah, but all these people are moving to the area. We have all these jobs. That's great. They still have to be able to afford where they live. Their salary is still only their salary. So what do? They either go move in with mom and dad, or brother and sister, or cousin, or aunt and uncle, or they start to roommate up. You start getting 2, 3, 4 people in one unit. What do you think that does to your demand? If you thought because of all this job growth, you were getting this much population growth, which you're going to, which is going to equal this much demand, well, you just cut that demand in half because people are doubling. That's what that's called, doubling. Okay. And that's what's happening. And so now you're going to see, if you look at CoStar and you look at the reports quarter over quarter, you're going to start to see vacancy increasing. You're going to start seeing rents stabilize or decline. It's already happening. Okay. So median household income is a test to determine your underwriting for projected rents. Your operating expense ratio. This is most important at the end of your business plan. So if you have a value add at year 2 or year 3, what is your operating expense ratio based on your projections? Now, here's how you calculate it. So for newly built, the best in the world, Greystar, they own 3 times more than the number 2 multifamily company in the world. They have over 100, I think they got over 300,000 units now. Just a massive company. The best they can do is 35% on a Class A, brand new, built, just delivered to the market. Okay. Now, caveat to that is your high rent markets are not going to apply. Los Angeles, San Francisco, New York City, Miami, these markets will not apply to this because obviously those $5,000, $6,000, $7,000 rents are going to affect that operating expense ratio. This is the rest of the country we're talking about. Older properties are going to be about 45 to 55%. Okay, that's your B's, your C's. The older it is, the higher this number is going to be. Can you keep a C property under 50%? Yes, you can. You better be damn good, but yes, you can. I looked at B and C properties in the Southeast. I looked at over 100 T12s in 2018, and the average operating expense ratio was 48% between B's and C's. Average was 48%. If the owner paid utilities, it was higher. If all the tenants paid utilities, it was less. If you had a great management company versus a crappy management company, there were some of the differences, but it all averaged at 48%. So take that for what it's worth. These are great tests to see if your underwriting is solid. Okay. For smaller properties, these are your, 2 to say 10, 12, 20 units. These numbers aren't going to apply because you just don't have economies of scale here that are going to drive those expenses up. So you only have 1 or 2 roofs versus 10 or 12 roofs. You have less units to deal with, less water heaters, less issues, less HVAC units. So your smaller properties, you can operate a smaller property, a good Class C smaller property at 40%. That's pretty typical. Okay. So that's not going to apply either. All right. So operating expense ratio is another test. And then the last is the loan, your DSCR versus your LTV. The lender rents or loans to the minimum of DSCR or LTV. So if you go to them and say, here's my financials, I want a 75% loan to value, and they come back to you and say, okay, in what world are you living in? I'll give you 55%. The reason your debt service coverage ratio in year 1 capped. Now that's going to be somewhere between 1.2 and 1.4. Again, depends on you, depends on the market, depends on the property. It's all risk for the lender. I've seen 1.15 one time in my life, and it was a Blackstone property. I've never seen below 1.2 other than that one property, which shocked me. I didn't even think they'd go below 1.2. 1.25, 1.3, pretty common. I do see 1.2s on some of the better institutional investors, companies, and I see 1.4s on some of the ones just getting started. So take that for what it's worth. But again, the minimum of the LTV or DSCR, whichever is lower. It isn't market condition. It isn't risk or anything else. When a sponsor comes back and says, oh, we couldn't get 75%, the lender is, they're adjusting their risk right now because of what's going on in the market. No, you didn't make your DSCR. That's why you got a 55% loan to value. So if you can get 75% loan to value, you've probably done pretty good on your underwriting on a permanent loan. All right. So that's a lot. So now what? Okay. First, if you own non-core assets, meaning You invest in multifamily properties, but you own some self-storage, you own some senior living, you own some mobile home parks, but your core is multifamily conventional, then you would need to, at this point, dispose of those non-core assets. Let me answer a question real quick. A permanent loan would be like Fannie, Freddie, any kind of credit union or regional bank. When we say permanent, we don't mean forever. Typically, that is based on what their risk is, but it's considered a long-term loan. It's not one of those where you're a balloon's due in 5 years, or it's a short-term 3-year interest only. And that's not a permanent loan is long-term. So anywhere from 15 to 30 years, again, depending on the asset, depending on the lender, depending on you, depending on the market, depending on the property. All right. I see a lot of Class C properties from regional lenders at 20% amortization. Permanent loan would be 15% to 30% amortization. Yeah, fixed rate long-term. Exactly. Good, Stephanie. Okay. Only purchase cash flowing assets. We talked about that. Get out of short-term debt. If you are in short-term debt right now, I do not care if your business plan is complete or not. Get out. If you don't get out now, you're going to miss the boat. If you get caught with that short-term debt going into the financial crisis when it comes, probably pretty early next year, you are going to be caught holding the bag. It's not going to be pretty. Get out of that short-term debt. Okay, create third-party opportunities. So if you're a broker especially, or if you rely on transactional income where you get paid many months after, you need to start thinking about consulting, coaching, training, kind of like what I do, to get you through the recession, because transactions are going to get less and less as we get into the recession. Now is the time to build relationships, right? If you have not started building relationships, you should have started yesterday. That old Chinese proverb, when's the best time to plant a tree? 20 years ago. When's the second best time? Today. Okay. Start building those relationships, or continue to build those relationships. So when the market does change and you find an opportunity, you have the relationships to help you close on that deal. Miguel asks, why dispose of non-core assets? Because you want to be able to focus on what your core is. It depending on how bad the recession can be, you don't want to have to deal with stuff you're not used to dealing with. Whatever your core is, could be core market, could be core asset. I had this question last time I taught this, where someone asked, well, what if I invest in Dallas, but I have properties in North Carolina, but my focus is Dallas? Well, get rid of the North Carolina properties. McKinley did this, what I consider one of the best management companies that are family owned, not necessarily institutional. They moved from Detroit to Orlando. They disposed of all their non-core assets about 3 years ago. They had properties all over the Southeast, but they determined their core was Central Florida. So if it wasn't in Central Florida, they disposed of it. Okay. So that's disposing of non-core assets. I hope that answered your question. Okay. Same question. So again, build relationships. Everybody says that location, location, location are first 3 words in real estate. That's actually wrong, because without relationships, location's irrelevant. If you don't have the people to help you close on the deal, oh well, location meant nothing. All right. So relationships, 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 first 3 words in real estate. I dig deep in the strategic partnering workshop on how to build relationships. So now is the time to educate yourself and immerse yourself in fundamental underwriting.